We know you're busy, and you want information you can actually use fast.
Hmm.
So today, we're doing a deep dive into something called Lincoln MoneyGuard Fixed Advantage 2025.
Yeah, we're looking at how it tries to tackle future care needs, but also, handle legacy concerns. The info we've got is from Diversified Insurance Brokers.
Right, and the big thing seems to be addressing that old use it or lose it worry people have with traditional long-term care insurance.
Exactly. MoneyGuard tries to bridge that gap by linking the long-term care part directly to a life insurance benefit. So you potentially get value either way.
Okay, interesting. So at its core,
Yeah.
what is this thing? Lincoln MoneyGuard Fixed Advantage 2025.
Well, it's structured as a universal life insurance policy.
Universal life.
Okay. It basically means it's got some flexibility built in, things like premium payments, maybe adjusting the death benefit later on, within limits, of course. And crucially, it comes packaged with a long-term care benefits rider. They call it an LTCBR.
So that rider is the key piece for the care aspect.
That's right. It's like a dedicated pot of money specifically for potential long-term care costs, sitting right inside the life insurance policy itself.
And in terms of that long-term care coverage, what kind of choices do people have?
You get options for how long the benefits might last, typically 3, 4, 5, or even 6 years.
Okay.
Plus, and this is important, you can choose inflation protection to help the benefit amount keep up with rising costs over time. You can pick 0%, 3%, or 5% compound interest.
Yeah, that inflation part seems critical. Costs always go up. So if someone needs care, what specific services does it actually cover?
It covers quite a range, actually. Things like home health care, adult daycare, stays in assisted living or nursing facilities, even respite care to give family caregivers a break.
That's pretty comprehensive. Now, I saw something about a point-of-claim payment choice. That sounds flexible. How does it work exactly?
Ah, yes. This is a really neat feature, I think. So when you actually need to make a claim, you get to decide how you receive the money. You can choose reimbursement. With that, you submit receipts for your care expenses, and you can get back up to 100% of your available monthly benefit.
Right, standard reimbursement.
Or you can choose indemnity. With indemnity, you get 80% of the monthly benefit paid out, and you don't need to provide receipts for how you spent it.
Oh, interesting. Less paperwork during a tough time, maybe.
Potentially, yes. And the key thing is you make that choice, reimbursement or indemnity, when you first make the claim, and it applies from then on.
Got it. That makes sense. Now, what about protecting the money you put in initially? People worry about that.
Good question. That's where something called the value protection endorsement comes into play. First, it usually includes a no-lapse guarantee.
No lapse, meaning?
Meaning, as long as you meet certain premium requirements, the policy is guaranteed to stay active. Even if the cash value gets low, it provides some security there.
Okay.
And it also offers return of premium ROP options. There's a basic one, which could return 70% of the premiums you paid, and a graded one that starts at 70% and increases up to 100% over, I think, 11 years.
So there's a chance to get a good chunk of your premiums back if you don't end up meeting the long-term care benefit.
Exactly. It addresses that what if I don't use it concern.
What was that other rider? Benefit transfer rider.
Right. That allows a beneficiary, someone who inherits from another MoneyGuard policy, to use those death benefit funds to buy their own new MoneyGuard policy. It can be a way to kind of boost their own future coverage.
Sort of a generational planning tool. How about paying the premiums? Is it all up front?
You have choices. You can pay a single lump sum, or you can spread the payments out, usually over a period up to 10 years, though it can depend on your age when you buy it.
And what's this split premium design mentioned?
That's about how they allocate the premium internally. They separate the cost of the basic life insurance from the cost of the long-term care rider.
Why do that?
Well, under current tax laws, and this is important, always check with a tax pro that separation might allow you to potentially deduct the portion of the premium specifically paid for the long-term care rider.
I see. Tax advantage potential, but definitely get professional advice. Okay. Switching gears slightly, the death benefit itself. What do beneficiaries actually receive?
Good point. The policy is designed so the death benefit paid out will be the greatest of a few things: the specified amount listed in the policy, the total premiums you've paid in, or a guaranteed minimum residual death benefit.
So there's a floor,
Yeah.
even if you use some LTC benefits.
Yes, exactly. Even if policy values decrease from payouts, there's still a minimum death benefit guaranteed, usually of 5% of the original coverage, or $25,000, whichever is less.
Okay. What if someone needs cash before needing long-term care? Can they access the policy's value?
Yes, generally you can access the policy's cash value through loans or partial withdrawals. That's the accumulated value in the life insurance part.
But there's a catch, I assume.
Definitely. Taking loans or withdrawals will reduce your cash value, and that directly reduces both the death benefit and the amount available for long-term care. So it's something to consider carefully.
Makes sense. Two other quick things mentioned, terminal illness rider and living well endorsement.
Correct. The terminal illness rider lets you access a portion of the death benefit early as a lump sum if you're diagnosed with a terminal illness, usually with less than 12-month life expectancy.
Okay.
And the living well endorsement just provides access to some extra health and wellness type services, not just for the insured person, but for their family too.
So pulling it all together, who is this really aimed at? Who's the ideal person for this MoneyGuard product?
I'd say it's really for folks looking for that combined approach. People who want to plan for potential long-term care costs, but also want to guarantee there's a death benefit left for heirs.
So addressing both needs in one place.
Yeah, and the flexibility, like that choice at claim time, plus the return of premium options, it appeals to those who are trying to integrate their retirement planning, their potential care needs, and their legacy goals all together.
Okay. So wrapping up, the key takeaway seems to be Lincoln MoneyGuard Fixed Advantage 2025 aims to be a combination product, blending long-term care funding with a life insurance death benefit, and it throws in some notable flexibility features.
That's a good summary. And it really leads to a final thought for listeners, doesn't it? How might fitting long-term care planning inside a life insurance structure like this align with your own financial picture? Could it provide that extra layer of, peace of mind? Definitely something worth thinking about in your overall strategy.